I was thinking I do a lot of talking about the stocks that I own. And after I've given it some thought, I'm going to keep continuing to talk about the stocks that I own. Hey guys, welcome back. I was reading an article this week about how for the last two consecutive years, the stock market has dropped. And there are forecasts that within the next 12 months that it's going to drop another 15% after roughly, I think, 3 and 5% or something like that. It said in the previous 2 years. And it got me thinking about the stocks that I own and where my purchase price is on all of those stocks and what I need to kind of forecast or look at moving forward. Stick around and let's talk about that. So, in a bit of a sorry, not sorry type of way, I'm going to start out by talking about the Telus stock. Telus is one of the two main players in Canada in communications, currently trading at $22.83, very, very close to its 52-week low. Pays a quarterly dividend that is currently sitting at 6.37%. Very, very attractive dividend. And its combined annual growth rate within its dividend over the last 20 years is over 11%. So, why is it trading at such a low value? Well, they have historically spent a lot of money in capital expenditures, and that was installing basically its 5G network, its fiber network, over the last 3 or 4 or 5 years, I believe. And during COVID, when rates were very, very low, it kind of made sense to do that. Here we are back in reality now. Rates are back up, and of course, Telus is still paying off or paying debt that it borrowed to do all of that work. So again, my own opinion, of course, these are always my own opinions, but they have not hit forecasts in earnings. And now the market is punishing them, and they're really taking a hit over the last little while. But look at the big picture and look down the road. This is one of two main players in the telecommunications field in Canada. And it's also branched out to a number of different things like TELUS Health. There was an agriculture division. And I just think to myself, this is a stock that's just way, way, way too big to fail. Or is there a fear of losing my money? Well, there's always a fear a bit of losing money in anything. But here's an example of literally a blue chip company, in my opinion. And in the next 5 to 10 years, this is going to do really, really well. So when I see a stock like this trading at $22.83, it's a no brainer. The problem for me and my wife is that we're very, very, I don't want to say heavily invested overall in our portfolio. I think we're about 7 or 8% in TELUS, which is a substantial amount. But picking up the odd share here and there at these prices just makes a heck of a lot of sense. And so when I hear the market going to drop another 15%, this would really put TELUS, if it's at all affected by that 15%, in true, true value territory. And there are already a number of analysts saying that this stock has been oversold. The next one I want to talk about is Northland Power. Northland Power is an $8 billion renewable company in Canada, pays a monthly dividend of 10 cents per share. And at the point where I got into Northland Power, this is quite a while back now, it was right around a 3 to 3.5% dividend. And currently, at the close on Friday, it's trading at a 4.88% dividend, close to 5%, which is kind of what you're getting right now in a GIC or in some of the better high interest savings accounts right now. But again, you've also got the look of the potential capital increase here. And Northland Power, not too long ago, was a stock estimated to go to like $40. So what happened? Well, over the last little while, they've had a quarterly report and it got hammered by high interest rates. From the looks of what I've seen, they've got a pipeline of work. It's not like they're not getting business, but the interest rates causing them to have to pay more in expenses because of interest certainly affected their bottom line. So again, to me, I try to look at that and I think, okay, those interest rates are not going to always be damaging to the company. Either they're going to pay off the debt eventually, or the rates are going to drop back down a bit and make it not as costly. If the pipeline of work is still there, then this share price should rise. And I personally, even though I'm an old guy, I love renewable companies because looking around the world right now, even here in Canada, good Lord, prayers to Kelowna, BC right now, and of course, Yukon territories. But looking at what's going on in our world, I think it's becoming more and more apparent that we need to get away from fossil fuels and we need to look at renewables. So here's a company that got damaged by their most recent quarterly report, high interest rates dropping the stock. And again, I always talk about time in the market is so much better than trying to time or timing the market. But sometimes, what's that old saying? Every dog has its day, or the sun shines on dogs. I can't even remember. For whatever reason, I really, really had a fortunate occurrence where mid part of last week, when I sold my last video, I explained how I sold some TransAlta renewables, given everything that's going on with them. And I wanted to keep a portion of that money in the renewables field. So I ended up picking up 34 shares of Northland, and I was able to get them at $22.90, which is a fantastic price, given what I believe this company is going to go to, and the forecasts of even what the analysts tell us. But at $22.90, I thought this is a great deal to increase my position. On Friday, for no other reason than I can think of, that then the market came to her senses or something, I don't know. But the stock went back up $1.23 to $24.58. So in a matter of a couple of days, I've increased my position's value by $57 and change. Now, I'm not going to sell it. You don't win or lose until you sell a stock, but it's totally increased the dividend yield because I was able to get some of those shares at 22.90 into my portfolio, dropping my average price. Um, and as I said, with 4.88%, you're kind of touching now on GIC rates, and that's just the dividend yield. So you're pretty much you're getting close to 5% your dividend every month. And so now I'm looking at the capital appreciation within the stock. And again, we're really, really close to 52-week lows on this stock, and interest rates are not going to stay where they are forever. And renewables are, in my opinion, a fantastic field to be into. So again, Northland Power, what am I going to do when the market drops? I get myself a little bit more of it. And the very last one that I'm going to talk about, becoming a real sweetheart just for my own sentimental feelings more than anything, Northwest Healthcare. There has been so much talk. This stock has absolutely taken a beating over the last year. It's dropped from almost $13, or actually just over $13, to $6.43 as of close on Friday. That's literally half of the value of this stock in the last year that this has dropped. And again, most recent quarterly reports from Northwest are actually not bad at all. Very high occupancy. Now, there was a change just this past week. There was the retirement or the resignation or something of the CEO. And there's a lot of talk online, a lot of chatter online about this now past CEO making some very poor decisions. Maybe, maybe not. I don't really know. I don't know enough about the situation. However, this is a stock currently trading at 643, as I said, which represents a 12.5% dividend yield. And this is now up in that really max yield, high yield territory. But it's a stock that doesn't have the same, in my opinion, does not have the same risk of some of those very, very high yield stocks. In that, I do believe once rates go down, because this company has a lot of debt and that debt is now at a higher rate of interest, that when those rates do ease off, that this value within the stock is going to go back up. So what do we do when a stock is $6.43 or less than half of what it was a year ago? Well, typically we purchase a little bit more of it. And then when those returns come in the capital, then you have a capital growth within your portfolio. But at the same time, as I keep saying, every time you purchase some of that stock at that much, much reduced price, you're increasing your yield so that when this stock hopefully goes back up into the $10 to $13 range, your yield on cost is going to be fantastic if you're able to pick up some of these shares. And again, this company is not struggling in any way as far as its business. One of the things that I have read it's doing is it is selling off some of its assets to lessen the debt load, which is a good and potentially bad thing. But again, healthcare industry, it's not something that's going away. And for me, a real estate investment trust is a very good monthly dividend payer. Probably something my wife and I'll do as we get more into our collective retirement years. She's already retired. I may move to something like this that's just more stable and just paying out dividends every month, and not as interested in capital growth at that point. This would be a great candidate, given that it's in the healthcare field, along with Slate Grocery, which is another one that I haven't really talked about a lot lately. Maybe I will in a future video. But we're always going to need grocery stores. We're always going to need to eat. And Slate Grocery, another great real estate investment trust. So that's going to wrap it up for today's video. The gist of this is, if the market's going to crash, let it crash. If you're truly invested and you truly believe in the stocks that you're in, grab some more of them, because when the market goes down, what's that old saying? You know it's going to go back up at some point. Hopefully, you're able to grab some of these really good valued companies when the prices rebound and go back up for you, giving you a great dividend yield, or potentially a great dividend yield. As I always say, this has not been investing advice. I've just looked at 3 stocks that my wife and I are invested in, and ones that I'm going to keep an eye on, because if they keep down at these rates, I might get a little bit more of them, so that when that rebound happens, our yield on cost is much better. And of course, there's some capital gain there. So, as I ask at the end of every video, if you've enjoyed this video or any of the videos on my site, I would ask you to please consider hitting that subscribe button. I'm getting closer and closer to 400 subscribers, and I would love to see that this week if at all possible. You can do that by clicking on that Marksy's Place icon in the video. Until next time, have a great coming week, and we'll talk to you soon. Take care.